A very good morning to every one of you who have taken time this morning to log in and join us on this webinar. I'm Wei Cheong from Deloitte and I have Sheila here. In terms of the webinar today, what we'll do is I will start the webinar by giving a broad overview of the global environment, followed by the current situation and environment in Singapore. And thereafter, I will hand over to Sheila, who will share a little bit more about the restructuring tools that are available in Singapore, right? And after that, we will go into a few case studies based on our personal experiences, life matters, to share with you how restructuring tools were used with positive outcome in those situations. And thereafter, we will move into Q&A, and that's where you can raise questions that you may have, and we will try our very best to answer them accordingly. Between January 2021 to mid-February 2021, globally there was a fall in the number of new COVID cases, and this is shortly after the COVID-19 vaccination was rolled out in December 2020 in various countries such as US, UK, and even in Singapore. However, we observed that the fall was temporary. Globally, the number of new cases started climbing again by end February 2021, and there is still no sign of it falling despite the ramping up of vaccination globally. As of last week, I checked that there are more than 600,000 cases, new cases daily. And cumulatively, this virus has caused more than 2.8 million deaths worldwide, and we have approximately 129 million confirmed cases to date. In terms of vaccination, 547 million have been vaccinated globally. Based on data from Bloomberg, the average global vaccination rate is approximately 6.67 million a day. At this rate, it is estimated that we will still take at least 4.6 years to cover 75% of the world population. 75% because that is what they deem as the level to achieve herd immunity. By region, the Americas has the most number of cases, with USA alone accounting for more than 30 million out of the 56 million in this continent. Europe is at close number 2, with even after multiple lockdown by various countries within Europe. Southeast Asia, where Singapore is part of, is at number 3, with Indonesia alone accounting for approximately 10% or 1.5 million of the 15 million cases, followed by the Philippines with 780 cases and Malaysia at over 350 cases. It's evident from the charts that you see here, which shows you the number of cases, new cases in various continents. You can see that most of the region have gone through at least 2 waves of COVID. In fact, Europe is currently facing a 3rd wave, largely due to the spread of the more infectious British variant. In Southeast Asia, we are currently looking at the 2nd wave. In Singapore, and this is data that we see every day, we have approximately 60,000 cases to date, and most of them came from the foreign worker dormitory cases last year. And since then, we have daily imported cases as well. Occasionally, we have a few community cases. But with the proposed travel bubble, I think we can expect to see more imported cases and potentially more community cases as well. But hopefully, with the rise in case, it can also be mitigated by the rollout of vaccination. As at end of March, we can see that approximately 16% of the Singapore population, including foreigners, have received at least the first dose of the vaccination. We understand that the target is to vaccinate all within the population who want to receive the vaccine by the end of this year. In terms of the economy in Singapore, the last 1 year was definitely a challenging period for most businesses in Singapore. And I believe some of you may have experienced that as well. In Singapore, we saw a 5.4% contraction of the economy in 2020, right? But despite that, we actually see a fall in the number of insolvency cases. In fact, this is actually a 5-year low in 2020. As far as insolvency cases are concerned, we're talking about liquidation, judicial management. And this, we observe, is mainly due to the various successful government measures that have been pushed out last year, including the various support scheme, GSS, and the COVID Temporary Act. But the risk to this is that the true fallout from this pandemic could be masked, giving the businesses here a false sense of security and stability. Based on the general sentiment that we, amongst the insolvency practitioner community, we expect to see potentially an uptick in the number of insolvency cases in the second half of this year. But having said that, with the increased pace of vaccination and the ease of travel restriction for vaccinated traveller, barring any unforeseen circumstances or a second wave of virus, it is expected that Singapore should see, a growth of between 4 to 6% in 2021. But again, as I mentioned repeatedly, with the mutation of the virus, there's immense uncertainty, about the nature and the timing and the speed of this recovery. COVID-19 has unleashed structural and systemic changes, and it is widely expected that recovery will be uneven across regions and sectors. The disruption to the economy as far as Singapore is concerned has been sweeping but also uneven, right? Many businesses face a challenging year, some were devastated, but there were also a few which were advantaged as a result of the situation. So really the starting point for recovery can be fairly polarized amongst companies here. And it is likely that the threat of the virus will continue to linger in the mid to near term, and consumer behavior may change permanently. Right? Businesses, I suppose, need to recognize that a return to pre-crisis normal may not happen even with an economic recovery. The future environment businesses operate in may be different, and for some sector, radically so. Right? It is believed that among most of us that we may be seeing a new norm emerging as a result of this pandemic. With this new norm, there will be one-time opportunities emerging as well, and accordingly, businesses should see the changes around them as an opportunity to radically reshape and restructure themselves to position themselves, for this coming new normal. Broadly speaking, this pandemic has created three types of companies. Those that are highly challenged by the pandemic, for example, our aviation industry, hospitality. There is still no visibility if and when these industries will recover to pre-COVID level. The uncertainty creates financing difficulties, as lenders will be mindful of financing them. So it's a very challenging time for them to get through before we see a broader recovery in the entire economy. The second group are companies that remain healthy, continue to operate with minimum disruption despite the pandemic. the issue we see for them is whether they are equipped and ready for growth in the new normal, that is to come. Because as I mentioned earlier, certain structural change may change accordingly. Consumer behavior may change. Companies will need to adapt themselves to this new normal. And finally, we have companies that have thrived during this pandemic. Your glove makers, some of your tech and online businesses. The question for them, I guess, is how long will this exceptional performance last? They may be sitting on a huge pile of cash right now. How do they then try and leverage on the resources that they have so that they can continue to stay ahead and grow further in the new normal? So in this crisis, there are emerging opportunities where potentially a combination of what I call defensive and offensive M&A can be leveraged upon to safeguard existing market, accelerate recovery, and position a company to capture market leadership. For example, companies propelled into survival mode by COVID-19, they may turn to M&A whether by choice or necessity to safeguard their future. They will need to identify ways to raise capital by divesting non-core assets and carving out underperforming businesses. They also need to improve their operation efficiency, business flexibility by identifying potential partners, or even white knight to tide through this difficult period. For companies that have been able to ride the upswing in demand caused by COVID-19, they will need to transform the business through acquisition to accelerate growth, including potentially acquiring distressed assets that are now at a historic low valuation. In this situation, be it defensive or offensive M&A, a key consideration for the parties involved is always how to mitigate risk, including how to carve out legacy issues, liabilities, but at the same time extract value by ring-fencing strategic business and assets post transaction, right? And to achieve this, restructuring as a tool should be leveraged upon by companies, and this is what we really like to share, through this webinar itself. Hence, a very important message which we hope participants of this webinar can take away at the end of this session is to appreciate that restructuring tool is not strictly restricted for highly distressed company, and it should definitely not be considered as the last option. In fact, it should be something on everybody's mind right now, given the pandemic. And before we get to the next new normal, we should all start looking at how we can leverage upon these tools, which include formal court processes and informal out-of-court processes. And these tools can be highly effective if used correctly, and we'll share more in the case studies that we will go through later. Sheila would then run through the type of tools that we have in Singapore, and you will also see in the case studies that we share later that there is a trend in terms of how the tools are being used and how we use a combination of these tools to achieve very positive outcome. So I will now hand over to Sheila, who would go through the tools that we have here in Singapore as far as restructuring is concerned.
Thanks very much, Wei Cheong. So going to restructuring options, as Wei Cheong mentioned earlier, there are informal and formal options. And when we say informal, it means that it does not involve the court. So therefore, you don't need to appoint lawyers, you don't have to go to court to make certain applications. There is the concept of a consensual standstill agreement or an out-of-court workout, and I'll go into that in detail in the next slide. Whereas the formal insolvency processes that it's supervised by the court, includes schemes of arrangement. You might have heard of that quite a bit in the news in relation to the bigger matters. There is also the Judicial Management option, as well as a simplified debt restructuring program that has been introduced just this year to cater to the smaller companies. So in terms of out-of-court workouts, it's basically a contractual arrangement where parties can actually come together, and agree, on a compromise. The benefit of that is that there is flexibility in that arrangement. There isn't, court or a third-party officer of the court or a third-party financial advisor, that is sort of appointed by the court to take charge of that, and therefore there are court directions, court timelines, to bear in mind. There is a lot of flexibility in terms of timing, subject of course to the creditors' views. The creditors might be, with or without the court involvement, might try to push things along. So that's something that always needs to be taken into account. And that's where engagement with creditors, at the very early stage is important. As Wei Cheong mentioned, we shouldn't wait till too late. When it gets to a point where, from the lender's perspective, for example, they get really very edgy. So early engagement, communication, it's quite important. There's also potentially lower costs, with an informal process that takes away the court involvement. So therefore, the roles of lawyers are very limited. We might only come in to the extent that there is an agreement to be entered into, and there might be some requirement for some advice from the legal perspective. If not, it's mostly the financial advisors who will be able to facilitate that negotiation and the preparation of the investment agreement, or the scheme of arrangement, or sorry, not scheme of arrangement, but the compromise agreement that's out of court. The disadvantage to that is that because it's consensual, and therefore it's just an agreement between parties, there is lack of a statutory moratorium. So what's a moratorium? A moratorium basically is telling creditors, no, you cannot wind up the company. You cannot commence proceedings against the company. It gives the company breathing space. They are not allowed to do these things while the company seeks out investors or negotiates with creditors to arrive at a compromise. There is also some difficulty in obtaining recognition by foreign courts, and that's because this is just merely a contractual agreement. In contrast, if it's a scheme of arrangement that is sanctioned by court and there is a court order, the scheme of arrangement can be enforced overseas by way of recognition. So that's something to bear in mind if there are creditors who are based overseas, or there are assets of the company that are also located overseas. And therefore, it's important to bear in mind the cross-border element. So coming to a scheme of arrangement, so earlier I had mentioned the informal process, the option is that of a consensual agreement where everyone agrees, right? Because if you don't agree, you're not bound by that agreement. But in the event there are a group of creditors, and out of that group of creditors, there are dissenting creditors. And there is therefore a need to bind these dissenting creditors to the same agreement. Then we have to go through a court process, and that's a scheme of arrangement, where there is a meeting, creditors vote on the scheme of arrangement. If there is then the requisite majority that passes the scheme of arrangement, and that's basically majority in number and 75% in value, then only then can we go to court and tell the court the majority has approved. There are, however, some dissenting creditors. The scheme is fair more generally to all creditors. Can the court please sanction the agreement, and therefore bind even dissenting creditors to the scheme of arrangement? So there is that process that's available. Earlier we talked about how in the informal process there is no moratorium. Therefore, parties have to agree for a standstill, not to sue each other. The benefit of going to court is that if there are some creditors that continue to threaten litigation, enforcement of, for example, there is a court judgment and they want to enforce that court judgment against assets of the company, going to court allows the debtor company to get a moratorium. So that is beneficial because then it gives the company breathing space to negotiate with the investors, to negotiate with the creditors, and to go through the process for a scheme of arrangement. So you'll see on the slide, sort of like a very brief timeline. What happens when we realize something's wrong? Appoint financial advisors, to advise on what can be done. What are the potential terms of a scheme that can be proposed? How can restructuring be done, not just in relation to the liabilities, the debt aspect, but also in relation to the business, right? Because it's a holistic restructuring and not just in relation to a compromise of debts. Then if there is a need for moratorium protection because creditors, especially the lenders, don't agree to a standstill, then we can apply to court for moratorium protection. And under the Insolvency, Restructuring and Dissolution Act, there is actually an automatic moratorium that kicks in upon the application being made. But it is a short one. It's only a 30-day automatic moratorium. And we do need to satisfy the court that the moratorium should be extended. And generally, that requires support from the creditors for that process. That means they think that restructuring is possible. They wish to support the restructuring process. And also importantly, from the debtor's perspective, there must be some plan, some basic terms of a scheme of arrangement. We can't simply say, I intend to go through this scheme of arrangement process. Please give me a moratorium protection. Terms of the scheme needs to be sort of set out, identifying, for example, a haircut, on the liability, a debt for equity exchange, for example. So and also there is also an investor in the works. It has already signed, a term sheet, for example, and things are really happening, and therefore we need that moratorium protection. Once that is done, you get that breathing space to sort of finalize and settle the scheme of arrangement, the investment agreement. Then we go to court for leave to convene the scheme meeting. At the scheme meeting then, that's when I mentioned earlier in terms of how the creditors will vote on it. And if the voting threshold is met, we then apply to court to get the scheme of arrangement sanctioned. Once it's approved, it commences. Then the liabilities, depending on the terms of the scheme, will be discharged either at the commencement of the scheme or at the end. It really depends on the terms of the scheme, and that's quite flexible. The important advantage of a scheme of arrangement process that is a debtor in possession scheme. So what does that mean? It means that the management remains in control. The directors, remain there. Management remains there. They run the show. They dictate what should be done. There is that flexibility in that process. It also might avoid negative publicity to the extent that there might be a misconception in relation to schemes of arrangement versus judicial management, for example, that there is actually a third-party court-appointed officer that comes in and takes over control from the management. So that's another thing in terms of optics. But that's changing in the recent years. Judicial management used to have that stigma in the very early years, but that has changed quite a bit in the last couple of years. From the cases that you have seen in the news, lenders are very open to the idea of judicial management being used as a restructuring option, and that's because not just in relation to the management issue, but because there is a process. There is a bit more supervision from the court, and that's something from the perspective of creditors. They quite like it. So there is a stigma that has already been removed from the last couple of years. Importantly, if we go down the court restructuring option, there's also a bit more, rescue financing that's available. So what's rescue financing? When a company is in distress, you might find that it's difficult to get new money. Banks, lenders are not willing to put in more money when a company is in distress. Under the Insolvency, Restructuring and Dissolution Act, there is a concept of rescue financing, which is where as the rescue financer puts in new money to help the restructuring of the company, that lender can be given super priority. So in the unfortunate event that the restructuring doesn't work out, the company subsequently goes into liquidation, that lender can get priority in relation to that amount of rescue financing provided. So there is that advantage that rescue financing can sort of provide in the context of a court-supervised restructuring process. There is also a restriction of ipso facto clauses. Very briefly, what ipso facto clauses refer to are those clauses in the agreement that you might have come across, which says in the event that the company is insolvent, or in the event judicial manager, or in the event that the company proposes a scheme of arrangement, the contract comes to an end, or the amount that is outstanding under the agreement is accelerated and is due immediately. These clauses are all held in abeyance when a scheme of arrangement is being proposed, or when a moratorium is in place upon application. So that's another advantage. It ensures that the company still has breathing space to continue and to perform its part of the obligations. The disadvantage is that depending on the creditor makeup, schemes can be blocked, bearing in mind the majority threshold. But this is also an issue when it comes to a consensual workout, because again, that's even worse. We need 100% agreement for any consensual workout to come into effect. There might be a perception that schemes may become long and protracted when discussions stall. I think that's something that applies across, whether it is in the context of an informal or formal restructuring option, because it's the engagement with creditors, engagement with financiers, that might lead to some complications, or it might be a bit more protracted than one likes. And that's where, like Wei Cheong mentioned, it's important to engage creditors, stakeholders early, so that they understand what's happening, and also if help is needed, help can be given earlier, and hopefully everyone's a bit more amenable to that. So what's a pre-packed scheme? So a pre-packed scheme is where we take away the requirement to go to court to call for a meeting. So we're basically saying that a meeting is not required, because even without a meeting to put the scheme of arrangement before the creditors for voting, it's already quite clear that the creditors are going to agree. It might be a smaller set of creditors, or they have been properly engaged, and they know what's the the scheme arrangement is, and they're willing to say yes to it. So turning to judicial management, so that's where I mentioned in relation to the appointment of a court officer. So if you look at the diagram there, the debtor company nominates a judicial manager and applies to court for a judicial management order. So a judicial management process is where the company or a creditor who can actually appoint an interim judicial manager basically is saying that there is some hope for the company, they can actually restructure. We should put the company into judicial management with the objective of a scheme of arrangement being proposed, or continuing the company as a going concern, or this is a process that will be beneficial to the company because the judicial manager is going to be in a position to realize assets more favorably than a company being placed in liquidation. So typically, in a liquidation, it's just disposal of assets, winding down the business, and assets might be sold at a much lower price, therefore not enhancing value. But if there is business that can be carved out from the company, or it can be sold at a better value as a going concern because of its name, for example, you're selling the trademark, you're selling patents, you're selling the goodwill of the company, it might be worth more, and therefore judicial management may be a suitable restructuring option. What happens then is that there is a moratorium that's put in place as well, so that's similar to the scheme of arrangement process. And that's the difference between this and the earlier process of a scheme of arrangement, is that a judicial manager takes over. So the directors are displaced in a sense. They no longer run the company. They might still be assisting the judicial manager, but it is the judicial manager that takes over control. This judicial management period is also limited. It's only 180 days, unless varied by the court. So the court can typically extend. And we have seen cases where 180 days, it's a little too short for the restructuring to happen, because the judicial manager needs to stabilize the operations of the company, and at the same time seek investors and propose a scheme. So typically we see that it's being extended. So again, in terms of the advantages, it's very similar. There's also the restriction of ipso facto clauses, the availability of rescue financing. That's also available to the judicial manager in the context of the restructuring of the company. Also, the company's assets are protected because of the moratorium, so that therefore the company can still continue business. And a disadvantage from the perspective of the company is the loss of control and management, as well as the possible negative publicity that I earlier mentioned, although I've said that the perception has changed. It's no longer as negative as the very early days back in the 90s, when judicial management was seen as, not being very successful, and there was that stigma attached to it, but that has changed. And we'll talk about it in the case studies where there have been successful cases where a company has exited judicial management and has continued to be, operating in business. And a flip side of the loss of control and management is that sometimes, perhaps from the director's perspective, they would want to step out. If they want to step out, and let someone take over, because for whatever reasons, it might be optically more beneficial to the company. This is also, a way to deal with it. So it's not so much a disadvantage, at all times. It can be an advantage depending on the requirements of the company. And this is the last thing that I would like to talk about in terms of the restructuring options, and this is the Simplified Debt Restructuring Program. And this is a response to the COVID-19 situation to help businesses with their restructuring process. This is, this came into effect in January this year. It's valid for 6 months at the moment, but it might be extended. This is sort of like a trial period. The Ministry of Law is sort of looking at it to see whether it's successful and might be extending it. This is for micro and small companies. Only a Singapore incorporated company with an annual sales turnover of not more than 10 million, a smaller company with not more than 30 employees, and not more than 50 creditors, and also the liabilities do not exceed $2 million. So this is for the smaller, the more simple restructuring, where there is a process that is shortened. It doesn't, require as many steps as would be required in a traditional form. So when a restructuring advisor is appointed, the financial advisor will assist, in coming up with a scheme of arrangement, and then also propose and help to engage creditors on that. The requirements are that the company cannot be in winding up, cannot already have been in judicial management, and cannot already have been undergoing a scheme. So this is a fresh option that can only be taken. So the very quick outline in terms of the process. There is an online, so it's simplified. There is no, complicated, court application or documents, thousands of pages where you need to sort of put in. It's just an online application. An application fee needs to be also paid. And once that application is notified to creditors, creditors have 21 days to object. Apart from the requirements I had earlier mentioned, and also on the earlier slide, the ministry will also take a look, at whether the company is suitable. So if the company requires specialized expertise, certain sort of knowledge that is very specialized, that's not suitable for a simplified process, then it wouldn't qualify for this. Once it's approved and the company pays a deposit, and this is a fixed fee of 18,750. So it's very manageable, and it's meant to assist the smaller companies and simplifies that process. The company then has 90 days to enter into the scheme. So this is a very fixed period of 90 days, unless extension is granted. And I think the general perception is that it should not go past 90 days because it's meant to be a simple, restructuring, a simple scheme. If not, it defeats the purpose of the Simplified Debt Restructuring Program. Then it's put to vote by the creditors. And this is where it's different again from the very traditional option. So earlier we talked about a scheme of arrangement, which is majority in number, 75% in value. For the simplified process, it's only 2/3 in value. And that's all. There's no need for a majority in terms of number, it's just value. So it's a bit more simple in terms of identifying what is required. And once that's passed, a very simple application is put into court. We don't need lawyers for that. In fact, it can just be the representative of the company making that application. And then the scheme commences when the court says, yes, the scheme is sanctioned. So that brings me to the end, of the brief overview of the various restructuring options, whether informal or formal. And now we're going to turn to, a few case studies, a couple of facts that we sort of go through, and to give you a flavor of how the cases have been successful over the last couple of years. So over to Wei Cheong.
Thank you, Sheila. So we have 5 case studies today, right? And these are all cases where either Sheila or myself were personally involved with, and they have provided positive outcomes to the stakeholders of the companies. And you can see in these cases, some of them, there's a hybrid of the court process with the informal process, coming together to give a positive outcome. And as what Sheila mentioned earlier, it's important to realize that actually in the Singapore's legal kind of a framework, restructuring framework, there is all these tools available for us, and they're quite comprehensive. But of course, one tool may not fit every cases. That's why in certain situations, we use a hybrid of cases to achieve the kind of positive outcome that we want to. So I will now go into the first case study, right? This case involved a Singapore headquartered company that was doing very well pre-COVID, right? Unfortunately, right, with the lockdown in various countries, it was affected by collection issues, right? Major customers, overseas customers started to delay payments. Because of that, the lenders to the company also became concerned. The company had in fact been very prompt and up to date in terms of its financial obligation. Whenever there was amount due to the bank to be paid, payments would be made. So the company was prompt. There was no default in terms of payment. But unfortunately, the COVID situation created concern amongst the lenders, because this was early days, somewhere in March 2020, when COVID first started and lockdown started everywhere around the world. With that level of uncertainty, the banks took a position, that they want to limit their exposure to the company. So they did not allow for refinancing, i.e. when a term became due that the company was expected to pay, the bank was not prepared to give fresh financing. So this added additional liquidity crunch pressure on the company, which was already facing collection issues. And when the company started to face these issues, one positive thing that they did was they approached us fairly early stage. So when the lockdown happened in March, April, and they start to face collection issues and pressure from the bank, they came to us as early as, if I recall, April, around April. So that's where we start to review the entire group as a whole, right? Look at this operation, its financial obligation, and we also start to engage with the lenders of the company to understand their concern, right? To get their support in terms of what we intend to do moving forward. And one of the key concern that the lenders had collectively was there's a little bit of loss of confidence as far as the management and the shareholders are there are loss of confidence, because there have been certain promises made, certain proposal being proposed, but they did not materialize, unfortunately, again because of the dynamic situation back then because of COVID. So there's some level of lack of confidence. So to address that, after discussion with management, the company eventually filed for judicial management, right, at the investment holding co level, which is the level that holds all the operating entities. And as Sheila shared earlier, a judicial management, or JM we call it in short, basically what then happened is the court will appoint insolvency practitioner like myself to come in as judicial managers. So the moment we are appointed, the powers of the directors will cease immediately. So the directors will no longer have powers in terms of decisions of the company, right? But they are still there. Management is still there. We do not come in and displace them. We only come in as court-appointed officer to oversee the group itself. So we came in, we started to evaluate the operation again, and we continue to engage the lenders. In fact, we then managed to negotiate what we call a standstill agreement, which is an informal process, with the lenders at the operating entity level. So we are the parent level, which has no activity except being an investment holdco. We had oversight of the entire group. The liquidity crunch is at the operating entity level. We went there, spoke to the lenders, they agreed to a standstill agreement, and with that, there is sort of a formal and informal moratorium for the entire group. Right? With that, we bought ourselves some time. We went out to market the group, and eventually we managed to find a white knight, who came in and made certain proposals to the lenders which was acceptable, and the creditors managed to receive 100% recovery. The group business remained intact, management intact, and even the shareholders managed to receive recovery, which is not that common in an insolvency situation, but in this situation we managed to do so. And the key to this positive outcome, looking back, is that the business was still fundamentally intact when we came on board, right? They started to face problem in March. We came in as early as April. Now, unfortunately, historically, businesses tend to come to restructuring advisors too late into the situation. It's only when they exhaust every single possible means that they have, then they come to us. At that point in time, unfortunately, sometimes the business may not be intact anymore. The business value may be gone. And in those situations, then it's more of a recovery process rather than a restructuring of the business per se. Right. So in this situation, fortunately enough, the management they are mindful enough to come to the professionals early on, and we managed to keep the business intact for the white knight to come in and rescue the company. And equally important is the role that the judicial manager, the JM, played. As I mentioned earlier, the JM coming in gave confidence to the creditors, especially the lenders, because these are the lenders that the JM in his course of work would have dealing with. So there's a certain level of trust that the JMs, being court-appointed officers, are independent enough and that they will look out to the interests of the creditors versus management, who may have other interests and agenda to consider. In this second situation, this case study, what is different from the first one? I mean, in the first one, we managed to, in a way, rescue the entire group, right? In this situation, it's a bit different. We managed to ring fence and save viable parts of a distressed group. This group is in the advertising technology space, right, with presence across Southeast Asia. Again, unfortunately, because of COVID, advertising activity went down drastically last year, especially during the lockdown period. So after careful discussion with the directors of the company, they decided to liquidate the group, and they appointed us as liquidators at the parent company. So after coming in as liquidator, I mean, for a liquidation scenario, usually it's quite straightforward. We come in, we sell whatever remaining asset there is, we recover, we distribute to creditors. But in this situation, it was a bit different. Why? Because after we came in as liquidator, at the parent level, we start to review each and every entity within the group. And we saw that there are certain entities, business within the group that was still viable. Yes, it's affected similarly to the rest of the group, but they're still viable. The business is fundamentally still intact. It may be facing short-term cash flow situation, but it is something that we felt could be addressed as long as we can find the appropriate white knight to come in and help the particular business and entity. And with that in mind, we then restructure the group. We hive out the viable business from other liabilities of the group, and that was something which the management previously couldn't deal with, because as management and directors, they basically were looking at the entire group as itself. So many a times it was taking something from A to plug the hole at B, you know. While for us, when we came in with the liquidation, there was also to some extent a moratorium as well, because creditors can't take further action against the company in liquidation. And with that, we had some time to look at the group, review, identify what we could hive out, and after again reaching out to potential interested party, we managed to find a white knight who then came in to rescue the viable business. So the key to this positive outcome is a little bit similar to the first case study, you know, that management directors came to us early enough. You know, had they come to us much later, even the viable business may no longer be viable, because it was already under tremendous stress as far as cash flow is concerned, and being associated with a parent that is highly distressed. This third case study that we have here is quite interesting. In this situation, we did not, in a way, rescue the group or even any particular entity within the group. Right? What we did was we, in a way, rescued viable contracts within this construction group. Right? This is a construction company. It was badly affected by major overseas projects, right, causing substantial liabilities. After our initial discussion with the companies and the directors and evaluating the situation, the directors decided to apply for judicial managers, to come in and see if there is still hope in trying to rescue the company. They had tried an informal process that didn't work, so they came to us and appointed us as judicial manager. In this case, it was a little bit late in terms of when they approached us, because they have spent more than half a year in trying to work out something informally with their creditors, but they couldn't get further with their creditors. And during that period of time, as a construction company, they couldn't tender for new project, which is very important for a construction company. You always need to be able to build your pipeline, be able to tender for new project. Because they were under stress, no banks provided them with any form of financing. Creditors, suppliers were asking for cash on delivery, which created further stress on the group. So when we came in as judicial managers, we reviewed the group, reviewed the business, and we quickly came to a conclusion with the stakeholders of the company, particularly the major creditors, the lenders, that it may not be viable to rescue the group as a whole. The liabilities are simply too substantial versus the available assets of the group, right? But being a construction company, contracts that the company had can also be considered assets, but they can also become liabilities in the event if we cannot fulfill our obligation under the contracts. So we discussed with management and we identify viable contracts that can still generate positive profits if they are being completed eventually. So we reach out to the project owners, we reach out to suppliers, contractors, subcontractors, and we spoke to the lenders. Eventually, we structured a management buyout where the management of the company set up a special vehicle where we then novate all these viable contracts over to this SPV that was set up by the management, right? And as a result of that, we managed to mitigate liabilities, contingent liability, especially liquidated damages for not being able to fulfill the contracts. And on top of that, we also get paid certain consideration for novating the contracts to the vehicle that the management had set up. So again, the key to this, what I call semi-positive outcome, is that the major creditors have trust that the judicial managers, being independent court-appointed officer, will act in their interest, right? That is very different from how when management and directors engage with the lenders, because at the back of the mind, this is already a business that had failed. So there is a certain lack of confidence because promises would have been made, but they were not fulfilled. While we come in as a fresh team talking to them, and because we have a relationship with the lenders through other engagements, so they know that we will definitely act in their interest. Assuming if it was still the management running the team, they would not be able to structure a deal as we have had. I can't see how the major creditors and lenders will allow them to novate out contracts to a company where they have interest. Well, in our situation, it is different. It is a situation whereby the lenders will be able to appreciate that we are really doing this to mitigate further obligations, liabilities, and yet at the same time extract certain values out of the contract that are still within the company itself. Okay, now to this fourth case study. In this situation, we represented an investor that was looking to acquire a distressed company, a distressed group, right? After carrying out preliminary discussion and review, due diligence, legal due diligence, they're still concerned that there may be issues, legacy issues and liabilities within the group itself, notwithstanding that the management and directors were prepared to provide certain undertaking. But the fact that some of the stakeholders were based overseas, they were concerned that even if there's undertaking, subsequent enforcement on those undertaking may be an issue. Hence, to address that, we advised the investor to structure a scheme of arrangement into the investment agreement, into the investment transaction. So as you heard from Sheila earlier, this is actually a court process. So assuming if the scheme is passed eventually, all liabilities, known and unknown, including contingent liabilities, would be extinguished. Right? The clear advantage of doing this is that it is, in a way, it helps to flush out any issues and liabilities that normal due diligence may not be able to surface, right? So I've come to case study 4. The next one, I'll hand over to Sheila, who will share with you case study number 5. Sheila?
Thanks, Wei Cheong. So case study 5, it's a very quick example, of a successful judicial management. So I just wanted to sort of share with you that in terms of judicial management, quite past the stigma, there are many cases, which are successful. And in fact, this was a judicial management case that only took 13 months, and that's quite a quick process in the circumstances, where there was a successful scheme of arrangement that was passed by the requisite majority of creditors and sanctioned by the court. During the course of the judicial management, the judicial manager stabilized the business, continued to perform the profitable projects, was able to negotiate, and enter into an investment agreement, and also engage with the creditors to make sure that the scheme of arrangement, when put to vote at a meeting, passed. So as the lawyers for the judicial managers, in that case, we saw the judicial managers reach out, very early to the lenders, to the various trade creditors as well, to get their buy-in into the proposed scheme. We also saw the judicial managers, work very closely with the management, and also the people on the ground, to make sure that business was still, very viable. In this case, in fact, what had happened was, in the course of the judicial management, they did hire, a new general manager. with many years of expertise in the area, to ensure that the business continue on, and was getting good publicity, and also getting a good reputation from the customers. So one of the key to success, in many of the cases, and also in the ones that we have been talking about today, it's that engagement is very important, and also the support from management. So notwithstanding that it's a court insolvency process, like a judicial management, where the powers of the directors, are seized, like Wei Cheong mentioned, they are still around, to provide assistance. Notwithstanding that, at the end of the day, it's the judicial managers who make that call, but they can't do things on their own. So management, are still around to ensure that they impart the knowledge of the company, and also to engage, with the various stakeholders. So that brings us to an end on this part of the presentation.